relatively quiet week ahead of us, although the pace of macroeconomic and corporate news flow is about to hit top gear, not least because the American megabanks such as JP Morgan Chase, Bank of America and Citigroup will kick off the fourth quarter reporting season on the other side of the Atlantic on Friday the 12th of January. Before then, the macro headlines are likely to be dominated by the US inflation figures for December that are due on the 11th and 12th of January, with the Consumer Price Index or CPI due on the former date, and the Producer Price Index or PPI or Factory Gate Price Index due on the latter. Now in November, the CPI rose by just 3.1% year on year. Along with June 2023's reading, that was the lowest score since spring 2021, and it tallied with the current preferred narrative of both the equity and the bond markets, which is that 2024 will see a cooling in inflation, a soft economic landing, with the result that the Federal Reserve will be able to pivot to cutting interest rates. Meanwhile, the PPI data offered further encouragement as it rose by just 0.9% year on year. Prices for final demand goods fell 1.5%, and those for services rose 2.1%, as the PPI reading came in below the Fed's overall 2% inflation target. With PPI a likely lead indicator for CPI, it seems logical to expect a further cooling in the headline number for CPI, although oil prices are on the rise and the base for comparison will start to soften too. A further retreat in the rate of PPI and CPI could reinforce market expectations that the Fed Chair Jay Powell and his colleagues may sanction a first 1 quarter point rate cut as soon as March and press on with up to 5 more by Christmas to take the Fed funds rate to 4% from its current mark of 5.5%. The first Fed meeting of the year, by the way, is slated for the 31st of January, the second one, the 20th of March. On the corporate front, retailers will be centre stage, as is the norm at this time of year, thanks to a rash of Christmas trading updates. A number of other sectors will see the release of year-end statements too, and half a dozen FTSE 100 companies are among those who are due to issue some sort of report or another. Names which may be worthy of further note for what they say about themselves, their industry, or the wider economy include the following, providing there are no last-minute changes to the dates. BM European Value Retail, Shoe Zone and Games Workshop on Tuesday the 9th of January, Sainsbury, Greggs, Persimmon and Hunting on the 10th, Tesco, Whitbread, Robert Walters and Hilton Food on the 11th, and Vistry and John Wood will round out the week on Friday the 12th. But the company which could just cause the biggest fuss in the week ahead is Marks & Spencer. The retailer, once a fixture in the FTSE 100, and now so again after the share's promotion to the headline index back in September 2023, well, it's due to release its Christmas and third quarter trading update on Thursday the 11th of January. The shares ended 2023 at their highest level since early 2019, buoyed by August's bullish trading update and then November's equally positive first half results, when some analysts felt management were even doing their best to put a lid on expectations so that nobody got too carried away. We'll come back to that in a second, but the first number to which analysts and investors alike will look is the total sales figure for the third quarter. A year ago, that came in at £3.6 billion. And certainly people will be looking for a higher number than that this time around. Analysts will then assess the implied year-on-year growth rate in the headline sales figure and, more importantly, the like-for-like sales growth rate. At the first half stage, food sales were up 11.7% like-for-like and clothing and home sales by 5.5%, so that total UK sales were up 9.6% like-for-like. International sales rose 3.9% using constant currencies. M&S doesn't tend to say much about the Ocado Retail 50/50 joint venture at this stage of the financial year, but any commentary on wider online sales developments will also be welcome. Clothing and Home's online performance has continued to improve, thanks to growth in both users of the app and also click and collect. Detailed comment from Chief Executive Stuart Machin on profits isn't usual at this stage either, although analysts will look for any updates given on the guidance given alongside November's interim results. At that stage, Mr Machin stated that M&S was not expecting too much help from the economy or the British weather, with the result that adjusted pre-tax profit will be more weighted towards the first half that ended in September. Now, M&S made £360 million in underlying pre-tax profit in the first half of the year, and over the past decade, it has, on average, made £100 million more in the second half than in the first, thanks in part to Christmas. That's why some analysts argued M&S was sandbagging the forecasts. Should Mr. Machin reference full-year estimates, the consensus in the immediate wake of the interims was £650 million in adjusted pre-tax profit and £526 million in stated profit. But those numbers look to have crept up by around £50 million each or so subsequently to around £700 million and £578 million respectively. Comments and dividends will almost certainly be left to the full-year results in May, though M&S did rejoin the dividend list with an interim payment of 1 pence a share. That was the first distribution since the first half of 2019. I hope that you and your families are all well and in good spirits. May I wish you a very happy new year, and thank you for watching, and I look forward to seeing you next time.